Hello, good afternoon. Thank you all for coming. Starting Oxford on time, 5 minutes past. This is an excellent turnout. Thank you for coming to this seminar on the future of banking and the role of challenger banks. My name is Alexa Zeitz. I've been associated with PEFM for the last 2 years. And we're delighted today to have Cyrus Ardalan with us, who can speak with an insider's perspective on the role of challenger banks. And perhaps also on those they are challenging. Cyrus is a former vice chairman at Barclays and the new independent chairman at OakNorth Bank. Cyrus led Barclays' engagement with key government stakeholders and its development of regulatory and public policy positioning from 2011 to June 2015. And prior to that, he spent 12 years as vice chairman for investment banking, with over 4 decades of experience in banking, also leading teams at Paribas, Chemical Banks, and the World Bank. So we're delighted to have you at PEFM here today. Thank you.
Thank you very much. Thank you.
Oh, and I should say before Cyrus begins that the presentation itself is on the record, but any discussion we have during Q&A is under Chatham House rules, so not for attribution. I appreciate that. Thank you.
Thank you very much, Alexa. Thank you very much for the invitation. I'm delighted to be here. Just by sort of introduction, I'm clearly not going to be taking an academic view of challenger banks. What I plan to do is to give you a practitioner's view of challenger banks and put that in the broader context of what is happening in banking in general in this country, but I think it's much more of a global issue. What it is I hope to convey is that we're really in a world which is changing quite rapidly, and end the presentation leaving you with some hopefully fruits for thought and some speculation as to where it is that we might be going in the future from where we are today. I think a couple of general observations at the risk of saying the obvious. When we say banking, it covers a very broad range of intermediation activities, which are all really quite different from each other. They serve different purposes. And they serve different entities and involve different competencies. Regulatory change and technology have had a dramatic impact on the economics of the financial services industry right across the board, across the various aspects of the industry. And this has really challenged the traditional models and sort of paradigms that we have been operating with. And as a result of that, what I hope to convey today is that I see ourselves really at the beginning of a major transformation of financial intermediation as a whole compared to the models that we have had in the past. I think some people talk about banking going through a Kodak moment. I don't think we're going to go quite through a Kodak moment, but it is definitely something which in the few years' time when we look back will be something akin to that. First, just a few general points, and that is that, as I said, I think when we look at banking, it covers a lot of different things. And we talk about retail banking, we talk about commercial and corporate banking, we talk about investment banking, we talk about wealth management, we could break it down even further pieces. But all these different types of banking are really quite different from each other. And oftentimes, when we talk about banking, they're all put together in a bank, and we sort of think them as being interchangeable and part of one big sort of soup of different things, but they're really quite different from each other. They provide a broad range of products, from financing products like debt and equity, to providing investment services, deposits or investments, down to much more sophisticated investments. They have risk management tools like derivatives and foreign exchange, payments facilities, and advisory work. They deal with retail vis-a-vis wholesale, individuals and institutional, private vis-a-vis public, buy side, sell side. And all of that means that when you look at the various aspects of these aspects of financial intermediation, even if they're sitting within the same institution, they involve radically different cultures, they involve radically different structures and skill sets, and the economics of these things are really quite different from each other. And I think that is really quite critical to know. When we talk about challenger banks, what generally in the UK falls within the challenger bank area are activities or institutions which are involved in the retail banking and to some extent in the corporate banking area. They're not involved so much in the wealth management side, not so much involved in investment banking, etc. So challenger banks typically fall within that spectrum, although I think in the future we will see also challengers developing in some of the other areas as well. The size of financial markets in general, I think, as we and it's important to bear this in mind, because when we look at challengers, we'll see that they really are playing a tiny piece of a much, much bigger puzzle. If you look at financial markets, for example, the capital markets, they're over $200 trillion in size. You look at risk management, it's $600 trillion of outstanding obligations. The 50 biggest banks in the world have balance sheets of $70 trillion. So, I mean, we're talking about numbers which are huge. And when we talk about challenger banks, we're still talking about very, very small numbers. And I think that's something to bear in mind. The current paradigm, and the one we're sort of still living under, is one which we basically was developed over the last, I would say, 20, 30 years. And that was characterized by increasing concentration and size. I mean, growing, merging with other banks, acquisitions, etc., were a key driver of banking up to the financial crisis of 2007 to 2008. Secondly, typically banks, many of the big global banks, became involved in all aspects of banking. So all the different things I mentioned to you, from retail to corporate to investment banking to wealth management, all began to fall within the same house. So the biggest, if you look at the top 10, 15, 20 biggest banks in the world, they were engaged in all these different activities. And thirdly, what is interesting about banking compared to other sectors is that banks historically were totally vertically integrated. Literally, they went from the transactions, operations, to the product development, to the management of the risk, to the end client side of the business, which is very unusual if you think about building a car. Mercedes or BMW buys components from 100 different people. It doesn't manufacture everything itself. Even design of the cars may be done by a third party, etc. It really pulls it together, assembles it together. But in banking, everything is completely vertically integrated, and that is kind of a very unusual structure, etc. And I think if you look, for example, in the 1990s in the UK, this trend of merger and growth is very, very clear. In the UK, for example, in the early 90s, you had a whole series of merchant banks. Warburgs, for example, a very eminent institution, was bought out by UBS. Kleinwith Benson was bought out by Dresdner. Horgevet was bought out by Security Pacific. Shorters was bought out by Citibank. Morgan Grenfell was bought out by Deutsche Bank. All these, very eminent institutions, which existed by themselves, were all basically pulled together because that became the model. Even within commercial banking, RBS basically and now West joined together. Barclays bought Woolwich. So again, you saw this whole trend right across the board. The 2007-2008 initially didn't change this, and in fact it made it worse. Why? Because we had a number of very distressed institutions, and what governments actually tend to do is to encourage people to buy these institutions, try and merge them. So actually went through a process of further consolidation of banking as opposed to anything else, and we saw that with Barclays acquiring Lehman Brothers, or that was bought separately out of bankruptcy. You had basically HBOS and Lloyd's and et cetera, and there are many, many examples of that. Bank of America, Merrill Lynch in the United States. However, this model this paradigm that underlay banking was driven by a number of perceived benefits. One, by having multiple products under one roof, there was a feeling that cross-selling was possible. So that was a really great thing. We could basically have a current account for somebody and sell them M&A on the other side, or do their securities business on the other side. So cross-selling became a key sort of logic behind this model. Secondly, there was a feeling that there were enormous economies of scale in banking. You have technology was a big, big factor, so you sort of had a big technology base, operational base. You're producing all these things yourself. You're highly vertically integrated, so the more stuff you could put through this thing, the cheaper it became per unit of production or whatever. And also, and quite critically, there was a lot of what I would call regulatory arbitrage. And that was driven by the fact that different aspects of banking were not risked properly. And I think the classic example is probably investment banking, which was not regulated. I think even commercial banking was massively undercapitalized, and we came to see that subsequently. But investment banking had very limited capital requirements, so you had huge trading books. You had banks which had repo books in the literally billions of trillions in size, with very limited amount of capital, because the analysis was very simple. They basically took historical volatility, did 2-3 standard deviations, said we're 99% covered if we have X amount of capital. It was a tiny sliver of capital. Why? For the last 10 years, volatility had been low and declining, and we hadn't had much volatility in the market. So people came up with very clever and very, very analytical ways of justifying very limited amount of capital, and nobody really questioned them. And when you put that together with commercial banking, you got a very powerful and toxic combination, because you had a highly undercapitalized entity called the capital market. You had banking on the other side, which would provide you access to deposits and a balance sheet and a rating, and you put these things together and you're able to blow up these banks into enormous institutions. Barclays had a balance sheet of £2.5 trillion in size, and some of the other banks were in between 1 to 3 trillion. When you think of the GDP of this country being, I think, it's 2 trillion or whatever it is, it's quite extraordinary that one financial institution should have a balance sheet of that size. So that was basically the world that we lived in. What people didn't realize immediately after the crisis was that there were really two very important things that are happening, and that were going to completely change the nature of banking in the future. One, and the economics of this business. One was basically the crisis was going to lead to massive regulatory change, and that was going to have a profound impact on the business models of banks. A, because it began to price capital properly and across the board, and I'll come to that. And secondly, technology, which was already developing, was really accelerating in many ways. Mobile phones, for example. The iPhone came into, was it 2007? Smartphones really began to take off at that time. Bitcoin technology, which underlies blockchain, for example, 2008. If you look at the introduction of sort of front-end applications, APIs, those began to really emerge. They started back in 2000, but it really began to take off in the late 2007, 2008, etc. So you have these two things happening, which really leads to what I would call the new paradigm. And the new paradigm is being driven by the two factors that I mentioned. One is regulation. And regulation has had a pretty dramatic and profound effect on banking. The whole question of efficiency of markets, the rational expectations model, etc., were all questioned. And with it, the need to, or the decision by governments and regulators to try and have a much more intrusive view as to what type of regulation and how much capital, how much support, and what sort of structures banks needed to have in order to be able to operate. Too big to fail became an issue. Banks, the view was that no longer should taxpayers be put in a position where they ever have to bail out a bank, so therefore capital requirements went up by factors of 5 or 6-fold. So you can imagine if tomorrow, I don't know, if somebody goes to BMW and says, look, you're going to have to increase your equity by a factor of 5 times, it's going to impact their business model a little bit. Liquidity levels change. For example, if you just take at Barclays, our liquidity levels, we held about £30 billion in liquidity. It went up to £150 billion in liquidity. Now, liquidity is expensive to hold because you have generally negative carry on it, especially in today's market, etc. And leverage levels are dramatically reduced. So the whole too big to fail became a major issue. People began to also focus on the whole question of too big to manage, and that led to a whole series of discussions about conduct, about bank structure, etc. All of this, in doing all this, regulators began to look at capital requirements and risk on a much more granular basis, and began to look at it within banks, prudential capital, but also within capital markets. That's trading desks, proprietary trading, all the different sort of activities that banks were taking. Structural reform began to become a factor because they said, look, we need to segregate those parts of the banking which were utilizing or may have been taking advantage of a sort of a regulatory arbitrage by having guaranteed deposits on one side. Hence, ring fencing in the UK was an attempt in doing that. Competition was it was decided to try and open up competition by payments systems being opened up to others, etc. And the whole question of conduct became a major issue following the scandals that, because of the collapse of the banking sector in 2007, 2008, but also the scandals that followed with LIBOR, with FX, but also PPI and other things like that, which are there. And so it began to completely transform itself. All of this basically led to, one, the cost of doing business increasing significantly, one, but more importantly, changing. The economics of the business, different parts of the business began to completely shift around very quickly. Transparency of risk was exposed. People, for example, if you look at derivatives markets, as a classic example. Derivatives today, I think outstanding derivatives are 600 trillion, but nobody knew who owned what, etc. And one of the biggest problems in the Lehman collapse was that Lehman had literally trillions of dollars worth of derivatives, and nobody quite knew who owed what to whom and where, etc. And how much real risk was attached to it. Some of it was not real risk. It was offsetting positions, but you still had no clue. So there's a move to try and create transparency through the creation of what's called CCPs, which are central clearing entities, where you have to actually register your derivatives and they have to act as an intermediary, etc. So transparency became a major factor. Bank structure, we have basically ring fencing in the UK, but in the US also similar measures were taken. And in Europe, there's still discussion about this. There was a major study done by Liikanen, and no decisions have been made. But again, they're looking at whether we should separate investment banking from corporate banking, etc. So dramatic change because of regulation. Then at the same time, we basically have technology coming in quite independently of what's going on the regulatory side. That in itself, if you had one without the other, would have been, pretty significant. But having both of them hit at the same time, I think became a bit of a double whammy. And technology basically meant that we began to be able to disaggregate things in a way that never were possible. And I think, I'm sure you've heard this, the biggest provider of transportation in the world is a company which owns no cars. It's Uber. The biggest provider of accommodation in the world is an entity which has no rooms. It's just Airbnb. So the model of basically owning things to provide them completely changed. It disaggregated. It began to allow you to disaggregate things in a way which was not feasible and possible. It enabled you the whole question of lean and agile systems and allowed you to move towards a system where you could have plug-and-play capabilities, where you basically created a core system into which you plugged in lots of different things, accounting systems, management information systems, payment systems, etc., which meant that you can basically no longer have to have a fully integrated system where you developed it all yourself and became very complicated. You can just say, okay, you have the best management information system, I'm going to take it and plug it into my system. The minute you're no longer state-of-the-art, I'll plug it out and plug something else in there. And I'm exaggerating how simple it is, but that's basically the way things were beginning to move. And it's not fantasy because we did it ourselves and a lot of other banks are doing it right now. Thirdly, big data became an issue. The computer capabilities that people had, the ability to store data and to be able to process data so quickly enabled banks or institutions to use data as a source of comparative advantage. And the notion that data, messy data basically is now actually hugely valuable because it enables you to do vast amounts of analytics on it and find trends, correlations, etc., which enable you to make decisions, began to become a major factor in people's doing it. Amazon, for example, Google, all these entities, etc. And the whole notion that your data has got to be absolutely accurate that's not the issue. You just need a lot of data. As long as you have a lot of data, that's what you need. So data as a source of comparative advantage became important. That's quite important when we look at banking in the future too, because banks actually have huge amounts of data, but they never look at it as a source of value added. It's just sitting in the vaults, etc. Artificial intelligence and machine learning began to come in a major scale. And now there's a lot of literature, and you're far more familiar with robotics and things like that, and whether that's going to take over the world. But the reality is it's already beginning to have an impact. You've got robo-investors coming in wealth management, etc. So new developments on that side, which are having a big impact. And blockchain is a different way of trying to basically deal with the operational side of banks in a completely decentralized and distributed way, which again enables you to move away from having your own central manufacturing. So all these things began to have a huge impact. This basically created enormous opportunities. One was basically to create these application programming interfaces, the APIs, which can basically sit on top of things and disaggregate. And obviously Uber, Airbnb are classical examples, but why not in banking? And we are beginning to see that exactly happening in banking as well. So you can segregate the machine from the interface with the consumer. So you can now basically break things up in a way. And that has a big impact, for example, on the use of the internet vis-a-vis branches. Branches were viewed as a major source of comparative advantage. How could you possibly dislodge Barclays or NatWest when they've got all these branches everywhere? You know, we can't compete. Well, you don't need any branches anymore. So it doesn't make it's not a source of comparative advantage anymore. Quite to the contrary. And in fact, I think a survey was done that customers are 4.5 times more likely to choose a bank with good digital platforms than with branches. And 10 years ago, that would have been just. You wouldn't have even sort of looked at that figure to come up with it. So you basically have the millennials with approaching things in different. You have a technology which is enabling you to do things in a very different way. And all of this basically began to challenge the vertically integrated, sort of all dancing, all singing model, the sort of the supermarket or the department store approach of banking. And basically began to raise questions about what is your real source of comparative advantage. That began to completely change and has changed right now. Scale, not necessarily anymore, because you can actually rent scale. For example, we put our whole technology on the cloud, which means that, frankly, if our transactions triple tomorrow, no problem. We just get Amazon, we just get more servers working for us. Before, scale was a big issue. You had to have it yourself. Cross-selling. You don't need cross-selling anymore because you can basically pick various pieces of this thing and do it yourself. Physical presence becomes no longer important, etc. So all of this, and then finally something which is idiosyncratic, which is very specific to today, and I don't think it's a long-term trend, but the fact that interest rates are at zero or negative interest rates, which means interest rate margin, which is a major source of revenue for banks, has also disappeared. So that puts even more pressure on banks. So you have regulatory change, you have technology change, at a time where the economic environment is already pressing down on your margins. So that really has been a dramatic change all around. So let's then, with all that, let's move on to the challenger banks. Where do the challenger banks fit into this broader, bigger picture? Well, in terms of what's going to happen? Yeah, I think that, let me go to the next slide first. I'll start up, go back to that one. Sorry. I think the environment that challenger banks were working in terms of the structure of the banking sector in the UK, I think is really quite important. And if you look at the UK, the big 5 banks account for 90% of the market. The big 4 account for about 80% of the market. And this goes across lending to SMEs, it goes across personal bank accounts, corporate bank accounts, etc. So the banking sector in the United Kingdom is highly concentrated. Secondly, no new banking licenses were issued in this country for over 100 years, which is actually, I found really quite shocking. Now, some of you say, well, wait a minute. 10, 15 years ago, I don't know, Sainsbury's opened up a bank, so what was that? Well, yes, Sainsbury's or Tesco's did open up banks, but those are not real banks. What they were was that RBS basically went and got a license on the back of its own license, so they had to do nothing but just go to the regulator and say, look, you know me, can you give me a license? Because what I want to do is white label something for Marks and Spencer's. And that's not really a new bank. It's just purely a white labeling of something. In terms of real banks, somebody who got a license, created a bank de novo, structured a bank, built a bank, etc., apparently, no license were issued for 100 years in this country. Yes?
Do you mind taking clarifying questions along
Please,
the way?
yeah.
So which type of entity is relevant for competition? The real bank or the Sainsbury's?
No, I think the Sainsbury's provided some degree of competition, okay? But one, they provided limited competition because 90% of the market is still in the hands of the 5. And secondly, they were not real challengers because they essentially were white labeling an existing model. They're working with the same paradigm. Okay? So I think the issue is going to be for the Sainsbury's of the world is whether, if basically the model underlying RBS collapses, for the sake of argument, then Sainsbury's is cannot operate because its host is no longer operating the way it's operating. So I think that the significance in terms of challenger banks is one, that even these little white labeling that was done really had a very limited impact in terms of the overall competitive environment. But more importantly, it is really through the provision of new licenses to people who start de novo in creating something that you're going to create something which is different. And that has not happened in this country. So nobody really tried to create a new bank with a new structure, new thing, etc. The other interesting figure is that the UK has 350 banks. I think this is according to the Bank of England. Germany has 2,000. France has 700, which again shows that the UK has a relatively small banks. Some of the consequences of this, and I picked this up later, is, for example, you find SMEs borrow 50% of what their EU and US SME counterparts borrow, and they're 50% less likely to ask to borrow. And some of this, again, maybe because SMEs don't like to borrow in this country, but a lot of it, they believe, is because there's just the environment's not been particularly conducive to lending to SMEs, and as a result, they've really stopped approaching the banks. The consequence of this has been that there's been a very high degree of apathy within the banking structure in the UK, because you basically had 4 or 5 banks which essentially looked the same, did the same, and provide the same services. So what's the point of moving around? It really didn't offer you a very differentiated product very much. So I think people found that switching of bank accounts, was very complicated for a long time. That's now been changed to try and facilitate that. But basically, there was a great deal of apathy within the system, so there really wasn't very much competition going on. Free if in credit banking, which means basically as long as you don't have an overdraft or you don't buy anything from the bank, you have a free bank account. It's something which is uniquely, well, it's not uniquely, but it's one of the characteristics of the banking sector in the UK. And that, again, has meant that cross-selling has been a very important feature within banking in this country, because if you're not charging for your current accounts, then you have to make your money through somewhere else, and hence you basically have to provide a suite of products. There's a lot of opaqueness and lack of sort of information asymmetry within the system generated by the banks, and again, there's been limited choice. And all of this was basically recognized through various different studies that have come out through the British Banking Association, the CMA, etc. Now, where does this take us in terms of why challenger banks? All that I've described basically suggests that what we have in the UK is a highly concentrated and vertically integrated banking system in the UK. And the UK, in a way, is characterized by a banking system which is very sophisticated. The UK is clearly by far the most sophisticated financial center in Europe and arguably in the world. So that's not the issue. But it's not diversified. It's actually a very, very undiversified financial system for domestic purposes, the UK. So it's highly concentrated, not particularly diversified, although very sophisticated, with competition being very limited. And also there tend to be there's a bit of a herd instinct. Banks tend to move together and doing things, etc., following each other and not really providing true diversity. And this, I think, came out very clearly in the CMA report, which was recently, which came out last year. And it basically highlighted that, both across both the retail side and with respect to SMEs, when they looked at consumer behavior, the type of services they're offered, etc., that there was what they called an adverse effect on competition. The structure had an adverse effect on competition in the United Kingdom. And they came up with various suggestions for trying to improve that. And there are measures have been taken. For example, portability of bank accounts was one suggestion that was made, in fact, by the Parliamentary Commission on Banking Standards. That was rejected, but instead we basically have now 6 days bank switching, which is very, very good. So you can switch your bank accounts very easily. The payments regulator has been opened up. They've taken a number of steps. But having said that, the banking structure in this country remained relatively undiversified and not particularly consumer-oriented. So with that background, it's not surprising that we basically had an enormous opportunity to see the development of a whole host of new financial institutions, because the conditions, the economics of the business was changing on one side, lack of diversity, highly concentrated banking sector, people generally not very happy with their banks, if you look at the promoter scores, etc., but still not doing very much about it. That really opened up the door for the challenger banks to come in, and also government policy being very much supportive, as well as things like the CMA report, etc., wanting basically this to happen. So what are and who are the challenger banks? Well, again, the term challenger bank sort of is kind of one of these broad terms which is a catch-all for a lot of things. I think that most people talk about challenger banks in the context of anybody who's not part of the big five. And I think it's probably okay to do that. So what you end up with is basically you have some large challenger banks, some of which are really long-standing banks. If you look at Clydesdale in Yorkshire, for example, I think it's a balance sheet of £50 billion right now and growing very rapidly, and actually a very successful bank. You have TSB, which is now spun out and which is going to grow. Handelsbank is obviously not a UK bank, but it's become established very successfully as a middle market lending bank in this country, with a very large number of offices particularly throughout northern England, etc. So you have those entities which are there and challenging, and they're, I would say more traditional looking banks, challenging the banks in a more traditional type of way. Then you have a whole series of new challenger and smaller banks that have emerged. These are smaller in large part because they're brand new. People like Metro, Aldermore, Shawbrook, ourselves, OakNorth, all have been established since 2000 or 2009, 2010. And they basically are focused on a number of different areas, retail, some corporate lending, and growing very, very rapidly from, literally from zero. Now let's say, banks like Aldermore and Shawbrook are about £5 billion in size balance sheet, £5-6 billion in balance sheet, so growing quite rapidly, and providing a differentiated set of products and approaching the business in a very, very different way. You have the large retailers, which are there, but most of these, with very few exceptions, are basically white labeling, and they're challengers, and I agree they provide a degree of competition, but they're really not transformational type of banks. The business model of these banks are very, very different. The Metros, Clydesdales, and Yorkshires, for example, are very diversified. They do both corporate and retail lending, as do, to a large extent, Aldermore and Shawbrook. You have specialized challenger banks like OakNorth. What we do, basically, and I'll come to us in more detail, all we do is we lend to small, medium-sized growth companies, and that's it. We don't have retail clients, we don't have branches, etc., which very, very focus on a very specific sector and do that. Paragon, for example, is on mortgages, buy-to-let mortgages. That's what it specializes. It does some other things, but that's really what it's known for. 90% of its balance sheet is that. And then you basically have the digital banks, Tandem, Fidor, Atom, and Starling, and these are basically purely digital banks. They have no branches, and some of them are provide very limited product base, like just in the case of I think it's Starling is basically just bank accounts. Some have basically just developed, bought their systems from third parties. Some have tried to develop it themselves, but a lot of it has been actually sort of, again, plug and play type of approach towards the technology they have. So again, it's a real mix of them. And I think what characterizes certainly the new ones, not so much the older ones, is simplicity. They're very simple products, very simple business models, really quite specialized in what they do. They're very, very transparent in what they're doing, very transparent in terms of their interrelationship with clients, in terms of their pricing. They're very innovative, and they really fill a niche. So what these institutions are really doing is trying to diversify the ecosystem that we have, which has been highly concentrated and very similar in terms of what the big players were. And this is sort of a bigger sort of picture of what you see. You have the sort of the existing guys, the big banks on the left. You've got the traditional challengers, you have the Yorkshires and the Halifaxes or TSBs, etc. You've got the retailers, and then you've got the next generation, which is basically for current accounts, a Starling, basically. And then you've got some new, again, digital banks like the Atoms and the Fidors. You've got the OakNorths, and you've got other sort of more specialized entities. And then underneath that, you have a lot of what are called neobanks, which are actually just front ends to banks. So they basically provide the front end, and they access another bank's balance sheet, and by providing a very clever and very user-friendly interface. which allows you to do lots of things, like, for example, access your bank accounts more cleverly, provide you better information. You can basically, they allow you to look at your spending patterns. They do use artificial intelligence to try and say, look, you should be doing a little bit more of this, a little bit of that. You could save some money doing this, et cetera, et cetera. So trying to be very, very sort of user-friendly. And then on the right-hand side, you have a whole series of other things which are non-bank challengers, and I'll come to that because I think that's important to bear that in mind when we talk about challengers in general, which are basically peer-to-peer and crowdfunding and other things like that. So now we're beginning to, if you look at what we had before, which was at the risk of sort of creating a bit of a caricature, the sort of top left corner being the world that we lived in, 90% of the world we lived in. Now we're getting a whole universe of different entities coming in. Now these are all very, very small in terms of size. So in terms of their impact today, they're relatively small, but they're all growing very, very rapidly. They're growing 30, 40, 50, 100% per annum. So the question is, where does the future take us? Is this a fad, or is this going to really take us to a new world? Now, some general points. Again, this is obviously a generalization, but overall, the challenger banks have had higher returns. They've provided higher returns to savers in their savings accounts because challengers obviously raise deposits. They have lower operating costs. They have higher returns on equity. They have higher book values, typically well over 1, sometimes 2, 3 times book value. Look at Barclays, is trading at 50% of book value, so very dramatically different than the other big banks. And they provided a much improved culture, or perceived to provide a much improved culture and service to their clients. The potential economies of scale due to size are outweighed by other factors because these are in small institutions, but they've been able to be as effective as they have because they've used technology in a much more effective way. They don't have the legacy systems that they have to live with. They've been very nimble in acquiring clients, customer acquisition, and they have very simple niche products which they can basically manage very effectively. The digital banks have been very successful by providing a very differentiated product. It's very personalized. It's an open system. It's very transparent, and the use of AI. Now, those that are more cynical about this will say that the success of these institutions may not have been driven by real economies of scale or a new paradigm, but maybe because it's the riskiness of these institutions is much higher than the traditional banks because they're less diversified. So they're fine right now, but something goes wrong, they have all their eggs in one basket. And also maybe they're successful because they're getting all the business nobody else wants, and so they're loading up their balance sheet with a lot of rubbish. And so therefore they're generating very nice returns, and tomorrow they're going to basically fall apart. But that's what I would say this cynical view. Yeah.
So just carrying on along that line a little bit further. So as you'd be aware, in many jurisdictions there's been the phenomena of a shadow banking system developing alongside a well-regulated banking system. Is the criticism that you just made from Interlocutor a sort of version of that people are saying this is a bit like a shadow banking system that's emerging, it's harder to regulate? And the follow-on question is, how, I know you're not a regulator, but could you make any comments about how easy you think these institutions are to regulate from an information point of view compared to the more established institutions?
Yeah, I'll come to shadow banking in a minute because I have a slide on that. I think the answer is that these institutions, and I can again only speak for the bank that I'm involved with because I'm obviously not in those institutions, but I can tell you that it took 2 years to build the bank to the point where we got a license. We're subject to exactly the same regulations that Barclays is, to the letter, on everything from senior management regime to prudential requirements to everything that you can imagine. And the regulators are every bit perhaps not every bit, I can't say, but certainly they're as intrusive in terms of coming and seeing us, talking to us on a monthly basis, having semi-annual reviews, etc., as anybody else. So
they're not as familiar with those institutions, are they?
Well, familiarity is that, what is familiarity? They look at our balance sheet, they look at our stress tests, we have to do our ICAPs, our ILAPs, etc. So familiarity, I think they probably have as much. I would say they probably they don't have the history with us. It's absolutely true, and I think that there's no argument about that. But in terms of transparency, they have a far more transparent view of what we are than, let's say, the big institutions, simply because we're so much simpler. And so they can see exactly what our loan portfolio is, where they can see, for example, to what extent it's secured, what the LTVs are, you know, who we lend money to, et cetera, et cetera. So I think that, you know, I think that from a regulatory perspective, I think that we're every bit as regulated, and I think we're safer than the big, but it's neither here nor there, but I think there's no reason to assume that we're not. And the regulators take this business very, very, very seriously. In fact, one of the criticisms against regulators has been that regulation has not been proportional. That the big small banks creating a small bank is as onerous as running a big bank. And that really discourages small banks from developing. And I think the Bank of England, the PRA, have taken some measures to try and redress that. But I think that if there is a criticism, it's more in that vein than the other way around. So let me just now take you to OakNorth. And why was, well, firstly, OakNorth was created from scratch, literally. We didn't acquire a license or do anything, start with anything other than just a plan. Why was it created? Well, firstly, its positioning is to be a bank for entrepreneurs. Now, why was this bank created? It was, if you could look at the two founders of the bank, they started this bank because they themselves had been entrepreneurs, and they created a business which they built very successfully, and they sold it very successfully to Moody's, in fact. And one of the things that they had experienced when they were building their business was that they had difficulty getting banks to lend money to them while they're building their business. And the reason, in large part, was because their business was in intellectual capital. They basically built a business of outsourcing very high-level research to India. And it grew to several thousand people, and a huge business. Very strong cash flows, but no assets. So the big banks were reluctant in lending to them because big banks don't like to spend a lot of time, especially for smaller sized companies, doing an in-depth analysis of their cash flows. Not because of any other reason, that it's complicated, it takes a lot of time. If you're making a £5 million loan, to put 2-3 analysts on this thing for a couple of weeks, put up all the balance sheets, do stress tests on it, look at the sector, et cetera, it's very expensive. And then try and continuously review the stuff. Just the economics of it doesn't work given the business models. So they basically decided when they sold their business, they're going to open up a bank focused on entrepreneurs, because they said, look, this is an area that just needs focus. And then if you actually read a lot of the literature around this thing, with the Breeden report and Roden report, there's a whole host of stuff, and a lot of think tanks have put out. There is a lot of literature around the fact that SMEs, growth SMEs, really face a financing problem. And I think that much of the discussion has always been around SMEs. SMEs have a problem, etc. But I think SMEs is a bit of, again, catch-all. There are 5 million SMEs in this country. But of those 5 million, 3.5, 4 million are single operators or family operators. There's 2 people owning a store, etc. And these are not going to grow. They have no aspirations for growing. They've got a nice little business, and that's what they want to be. So and then what they need is basically, bank accounts and simple payments, credit cards, and things like that. There's a small subsection of SMEs, which are what we call growth SMEs. These are companies that really have growth aspirations. They're in a business which lends itself to growing. The people behind it want to grow the business, etc. And it's that group which is really critical to the creation of employment, to the creation of GDP growth, etc. in this country, or any country, etc. And that area historically has been underserved in this country. And it's been underserved in 2 respects. One, a lot of the literature basically focuses on the fact that we don't have enough venture capital, equity, because they need a lot of equity because they're very high risk by definition. So equity is a natural thing for them to need, and that is probably the single most constraint on the growth of entrepreneurs and companies in this country, and measures are being taken to try and address that. But also there's a debt issue, because again these companies typically are very idiosyncratic, very complicated to look at, and the big banks, unless they happen to have assets, in which case the big banks will support them because they say, fine, you have a house, we'll take 50%, we'll lend you 50% against the house. Yes, you got a very nice business. I'm sure it's going to do very well. Thank you very much. As long as you got 50%, cover, they're not really interested in what the business is, because it's too complicated for them. They're just, and it's natural. The business model doesn't lend itself. So OakNorth was basically designed to try and fill the gap on the debt side, not equity side, for this sort of subset of companies, SMEs and medium-sized growth companies in this country, which we think are very, very critical, based on the experience of the two founders, but also the fact that it is actually a gap which needs to be filled. And the way that we're able to basically make this model work, and in that sense we're a very traditional bank, where there's nothing very fancy about what we do. The way that the new world has enabled us to do this and allow us to basically focus on a very narrow area and make the economics of this thing work is driven by two factors. One is technology, because we can have this basically very efficient platform that we've created, which we were the first bank in the UK to put all our technology on the cloud, which is completely scalable, and it's very much of a plug-and-play type of approach. We basically find the best providers of different components, plug them into a central banking model that we have, and work with that. Now, I'm oversimplifying it, but it's broadly that, as opposed to something which is highly complicated, intertwined, etc. You want to make a change, everything has to change, which is what the legacy systems are like. Secondly, our analytics. The way we dealt with the analytics side, again, was basically interesting. We basically offshored our analytics to India. As it happened, the founders had this expertise. And we put an office in India, which has about 20 people in it, about 10 of them are PhDs. So basically, we can give them all the balance sheet data that we get from the client. They create the spreadsheets. They model all this stuff. They do the stress test. They do the analytics on if we're lending to restaurant chains. What other restaurant chains are there? What's their experience been? How much do they earn per store? What their locations are, et cetera, and do that in a very cost-effective way. So the combination of that, plus a very low operating platform, enables us to lend to these companies on a very idiosyncratic basis, at a very cost-effective basis, and make a very decent margin on it, and provide a very personalized service. Okay? So that's basically the model. Funding, how do we fund ourselves? Again, the new world, you have price comparison sites. Any of you can basically go on the internet and put your money with any bank, including ours. And as long as you put it for less than £75,000, it's the same risk as Barclays. It's all guaranteed by the government. So, it's the same risk. So basically, these price comparison sites, again, allow depositors, a subset of depositors, to search for yield and feel comfortable enough in working on the internet to basically deposit their money with banks like ourselves. And so we found that it's a highly elastic process. The minute we increase our spreads a little bit, the money flows in, and yeah.
That phrase, it's all the same risk as Barclays, reminds me of free rider problems in any financial environment where you have a group and the whole group relies on the reputation, the general reputation of the riskiness of the institution, and any one institution has a temptation to free ride on that risk and undertake riskier activities.
It could happen. I think that is, if you have any form of government support for deposits anywhere, that's absolutely true, but that's true of any bank. It's not of ours. It's the same true of any of the big banks. And I think the way that that's obviously being squared is, one, everybody pays insurance into the government scheme, so that it's a funded insurance scheme. And secondly, you have regulation. The regulators are basically there to make sure that doesn't happen. And that's something which they're I can tell you, incredibly vigilant about, etc. So when you have capital ratios which are running now between 10 and 20% of your assets, you basically have a huge degree of protection against that. But I think there's obviously that. But the point is that, again, here's another example where 20, 30 years ago, you wouldn't have been able to do that. Now you can basically get depositing being segregated from putting your money in a bank directly. You don't have to have a bank relationship to put your money somewhere and get it and deposit. So you've been able to disaggregate that layer, not for everybody, but for people. So again, it's a process of disaggregating pieces, which enables you to reconstruct things in a different way than you did before. And we basically got. It took us 2 years to get licensed. That last year. The bank is, we initially started off with 20 million in capital. We raised another 60 million capital within 5-6 months. So we have around close to 90 million pounds in capital. Our balance sheet is up to about 200 million. And we announced last month that last month was the first time we broke even So we're basically on track on what we're doing. We have a very, I would say, you mentioned, free rider or risks, etc. It's because it's if I look at the role of the board, for example, in a bank like this, because it's a small institution, because it's very specialized, the board is intimately involved in what goes on, to the point where any credit decisions of over a certain size come to the board, credit committee. Mm-hmm. So we really are right on top of what's going on. Culture, for example, the values of the institution, and its purpose, etc., are all very closely looked at by the board. So again, having an institution which is very focused, very specialized, enables you to do things in a way which becomes much more difficult if you're very, very, very broadly based. So that's a little bit about OakNorth. Now, you mentioned shadow banking, and I thought I would talk a little bit about shadow banking, because that's another form of challenge. I mean, if you want to talk challengers, they're not challenger banks, but they're certainly challengers. And I think shadow banking, again, is one of those, I think, unfortunate terms, because it sort of gives the idea that it's sort of either in the shadows, or it's kind of there's something sort of sinister about that type of activity. And the areas of shadow banking that were focused on post-crisis were actually, in some ways, not at all shadowy, nor at all inappropriate. Those are the areas of securitization, repos, and money markets. Those are the areas that people said are shadow banking. I think the term was essentially used for non-banking sources of credit, and basically a repo enables you to take an asset you have and get cash against it. So it's kind of a type of borrowing. Money market funds is, instead of putting your money as a deposit in a bank, you put it in a fund which is not guaranteed by the government, etc., and buys commercial paper or whatever it buys. So I think there were issues in terms of securitization, repos, and money markets in terms of their transparency, in terms of some of the regulations, lack of regulations, etc., around them. But each one of them fulfilled very, very important roles. And I'm not going to speak about those, because those are kind of a little bit separate from what we're talking about. I think the areas which have a much more direct bearing on challenger banks and challengers, as we speak about them, is the area of peer-to-peer lending and crowdfunding. And these areas have grown very, very rapidly. And peer-to-peer is typically debt, whereas crowdfunding is typically equity. The size of, you get a number of, for example, in the peer-to-peer area, a number of players in the UK which are quite well known, as Zupa, RateSetter, and Funding Circle. They've been growing very, very fast, 50, 100% per annum. However, they remain relatively small. If you look at, for example, the size of this whole sector of alternative financing, which is peer-to-peer lending and crowdfunding, in Europe in total, it's around 5 billion in size, which is still tiny, absolutely, of which 80% is in the UK. If you look at it globally, it's around 100 billion in size, again growing very rapidly. It's about 100 billion in China is the biggest one, and around 30, 40 billion in the US. So growing fast, but still relatively small. But again, fulfilling, I think, an important niche, and doing something which was not, which I think was a gap in financing. I think the questions with this area are more in terms of regulation, because they're historically not regulated, although now the FCA is now licensing peer-to-peer platforms, etc. So I think it's taking some step forward. It's really making sure that people using these platforms really know what they're doing, and you don't end up with uneducated people using them and saying, oh my God, I can put my money at Barclays at 0.2%, I can do peer-to-peer lending at 10%, and assuming it's the same risk. As long as they understand it's a very different risk, and they may not get their money back in one. On the other hand, over time, they may well do quite well on it, but it's a different world. That's fine. I think the other challenger is interesting one is the British Business Bank, which was set up. It is a challenger bank in a way, and that was again set up to address some of the key weaknesses that I mentioned for you in the SME sector. So they're actually trying to address some of the equity issues as well as the debt issues, and so working with banks like ourselves to try and help us do more in that sector. So it is a challenger bank, it's a public challenger bank, and is it going to remain in public hands? I don't know. If you look at the Green Bank, that's obviously sort of moved out of public hands, and you can imagine this, if it's successful, could eventually be privatized as well, but it certainly, I think, has an important role and deals with some of the market failures that we currently have in this area. I think it would be remiss for me not to just say one or two words about the capital markets as well, because that's a challenger. And I think there's a lot of discussion in Europe about capital markets union. And I think it's important to mention that, because if you look at, for example, in the EU specifically, less so in the UK, in the continent, 80% of financial intermediation is done through banking, only 20% through capital markets. The US, it's virtually the other way around. So there's a major initiative within Europe, with the new Commission, to try and promote the development of capital markets in Europe, and that's obviously, it's another challenge to banking, to try and sort of provide an alternative sources of financing, but through the capital markets, albeit on a regulated basis, because those are, again, regulated entities. It provides a means of diversifying funding sources, because it provides a different type of funding through bonds. They're much more long-term and much more structured type of products. It allows people to, it potentially enables for greater savings, because it gives savers many different new types of forms of saving instruments, and therefore it also can provide a lower cost of funding than banks do, because you avoid basically the need to have a balance sheet in the middle. I think the challenges there are basically regulation has really made capital markets quite, the economics of investment banking have been very dramatically negatively impacted, because it was not particularly regulated before from a prudential point of view. Now that it is, and I think that's made a big impact. I think Brexit could have a negative impact on this, particularly for Europe, because UK was, the commissioner responsible for this was Lord Hill, has now obviously left, and the greatest knowledge about capital markets resides in this country, and with the UK out, it's, that's going to have a negative impact. And also finally, there's an issue within continental Europe particularly, that you lack institutions to actually promote capital markets, because capital markets require people who buy, sell securities, trade securities, hold inventories, do syndications, etc. And you have very few institutions in Europe that do that. The US, on the other hand, has a vast range of institutions that are very good at doing that. But I just mentioned that for the sake of completeness. Which really brings me towards the end of my discussion. So, what is the future of banking? I think we're shifting from a highly diversified, vertically integrated structure to what I would call basically open banking, to something which is now going to become much more of an open architecture. This, I think, is going to potentially lead, and this I'm speculating at this point, obviously, to what I would call a vertical disaggregation and a horizontal disaggregation of banking. And I'll show a little diagram which tries to explain that. The result of this will be we're going to have a much more diverse ecosystem of smaller and more specialized financial institutions. Certainly initially, eventually you might get some of these merging and creating other groups, but the groupings will change. I think you're atomizing the banking, potentially atomizing the existing structure, and things may come together in a different form as we move forward. I think it's going to be more focused on clients. I think more focused on domestic clients. I think a lot of these trends are basically very much focused on providing domestic services as to trying to become a global bank, providing all types of activities. I think capital markets will remain global, but commercial banking, I think, will become even more domestic than it probably has been in the past for a whole host of reasons. It will be open architecture. I think there'll be a lot of focus on behavior, the millennials, how they basically interact, how individuals interact in wanting this service, which would drive the type of services and the type of structures that we create. And I think in that context, the challenger banks are very well positioned to do this. I think the big banks have a huge handicap, a number of handicaps. One, they're very large. There are huge ships trying to shift their direction. It's not because they don't understand this. They have massive problems with their legacy systems, which they can't switch off because they cannot afford to have anything go wrong with their systems. I mean, we see if the ATMs basically stop for half an hour, it's a national scandal, and it should be. So they have real problems in trying to see how they can basically move from one model to another, but they're trying very as hard as they can to do that, etc. And also to see what exactly their real comparative advantage is going to be in this new world. And if you look at it in terms of my point about the way the banking is likely to evolve, is you can see, for example, the old model, let's say the RBS or the Barclays, where Barclays has had lending activities, had investment activities, had advising activities. It had its operations, which is its engine. It has risk management, which is its portfolio, its balance sheet, and it has clients on the other side. Now, in the new world, you can basically start cutting these things across, and you can see, for example, the client side could be taken over by APIs. You can basically people create interfaces that tap into somebody else's engine. Okay? And so you can have a situation where you have one group of institutions that basically provide you access to an engine which does all the processing. And there'll be a third entity which maybe manages all the risk. Why not? You could have pieces which are very specialized. For example, you could have a front-end piece right at the top corner which provides for lending on the digital, basically a digital interface for clients to access somebody else's balance sheet to borrow money. That entity itself doesn't have a balance sheet. It doesn't have operations, etc. It just has a front which does that. So how this actually will eventually work out, I don't think anybody really has an idea. And there are lots of interesting ideas about platforms. Basically, maybe banks will ultimately become big platforms, because what they have is huge amounts of data, and they'll see that their real comparative advantage is having this massive amount of data that they can actually use very effectively and sell to third parties for doing all sorts of analytics. And the front end will be taken up by a whole set of new institutions that will provide the access to the clients on the other side. And the balance sheet itself could be managed maybe even by, through the capital markets, etc. So very difficult to know at this stage where the world is going. But one thing, and I suspect that we'll still have some institutions which will look like the old. In other words, if you look at it on the high street, the example I give, which is not necessarily a particularly accurate one, but I think it sort of reflects it, 30, 40 years ago, I recall seeing a lot more department stores. You see far fewer department stores. Doesn't mean that we're not going to have any department stores. We still have John Lewis. We have a few which are out there. But department stores are becoming less and less. And instead, what we're finding is specialized stores on the high street that provide, you want to buy suits and clothing, you go to this one. You buy shoes, you go to this one, etc. As opposed to going to the department store where everything's there. So I think we're going to move more into this type of world. So in conclusion, I think it's important for us to have a diverse ecosystem, and I think the challenger banks and all the developments that we've seen are taking us in that direction. Technology, regulation is, I think, creating a seismic shift in the way we're going to see banks. And the sources of comparative advantage, size, complexity, specialization, etc., all these things, regulation, are all going to change in the future. So that's what I wanted to leave you with.